We have with me Mary Stansmore, who is the Director of Engineered Solutions with American Carbon Registry. We have JP Brisson. He is a partner with the leading law firm Latham & Watkins. We have Vipul Shetty, who's Director of Energy Transition at Howden Insurance Brokers. So warm welcome to you. We are here to discuss how to finance carbon management. It's been the carbon management industry has been seeing very significant growth in the past few years. As the Global CCS Institute, we are an international think tank that aims to advocate for carbon capture, utilization, storage, and removals in the range of, as a part of key climate technologies, amongst others, such as energy efficiency, renewables. And we've added almost 200 new facilities to our project pipeline last year, which saw a record growth. Currently, we have 41 facilities in operation. We have 26 under construction and more than 300 in different stages of development. So really impressive growth in the facility pipeline, which is great. But now we have to turn to real life matters, such as we need to get financing for these projects to be built. We need to get the permits in place on time and in place. So the topic of this session is to mobilize finance, as one of our speakers who's hopefully going to join us said, get the finance working and the rest is deliverable. So perhaps if I may start with JP, for carbon management to be viable, we need investable business models and supportive policies. That's often mentioned as one of the kind of key drivers for bankable business models. Are you seeing where are you seeing sort of most progress in terms of policies that enable carbon management deployment?
Well, first of all, thank you very much for having me, and it's great to be on the panel with you. And good morning, everyone. So, yeah, it's interesting. My colleague here, JP Sweeney, is from London, and I work on several projects. A few in the Middle East, a couple in the UK, and several in the US. And it's interesting, right? The way the incentives have been created in each jurisdiction has resulted in very different financing environment, right? The 45Q in the US obviously is a very strong driver of interest by the commercial sector, right? So we are seeing more projects in the US in development than anywhere else globally. But when you actually look at individual projects, what GP and I concluded this week when we were working for a client is that really the UK probably has the most stable incentive program. And essentially the reason is the UK has selected a limited number of projects, and the UK government essentially providing a wrap around liability and cost, differential. So, to get the, project started, I think the UK probably in the short term has probably the best system, but one that is allowing only a limited number of projects going. In the US, because the industry is still in its infancy, we are seeing most projects being done on balance sheet, and the projects that are progressing the most are those that are sponsored by the majors, which have enough capital to essentially get the project up and running, with the hope that once the project is up and running, it will be able to qualify for commercial finance. And I would say finally, we are working on the Saudi Aramco 10 million ton per annum project that was announced last year. That project is intended to go to commercial operation by 2026. We think that project will be the first project where there will be a commercial finance, project finance package, on the project. But the reason why that's possible in Saudi Arabia is because you have a very strong government that can provide strong guarantees. So that will be the first project, but we'll have to see whether that can help, mobilize, interest in the space.
Thank you. Indeed, one of the kind of key things that we're looking forward to seeing, as you've said, JP, is that a lot of the, almost predominantly all of the existing projects have been financed on balance sheet with support from governments, grants, etc. And of course, if we're going to scale up from where we're today to say, I mean, as 1 gigaton is the number that IEA talks about for 2030, we'll certainly need to have commercial financing come into the picture. If I may turn to Vipul, because you mentioned liability, insurance, what are the key risks that the insurance industry sees with carbon management? Is it on the technology side? Is it on the storage side? And are there available products that can be applied to these projects?
Yeah, thanks, Gloria, and thanks for having me. I think there are a lot of liabilities and risks involved in the CCS value chain when we talk about the capture technology, the transport of CO2, whether it's via pipeline or whether CO2 carriers, and then the liquefaction, compression, and finally the sequestration. So the risk in the value chain is at every stage and point. And the liabilities specific come very clearly in CO2 escape, right? Anywhere in the value chain, it's not only at sequestration, it could be a pipeline leak, it could be a rupture within the units itself where they're capturing CO2. So the risk is all over the place, right? There's no specific area where we've identified that has more risk than the other. Yes, at the sequestration side, obviously, because of the volume, there's a lot more, but across the value chain. So what are the solutions out there? The solutions we've developed and the projects we have already placed insurance coverages for cover the construction phase all the way from the development or capture site to sequestration, including the transport via pipeline or marine hull and cargo, what we call. We also have or are working on rather environmental liability cover, and that will be a blanket cover across the entire value chain. So from capture all the way to sequestration, there are insurance solutions available. I think the main issue with insurers right now is to understand the technology, right? The capture technology, compression, liquefaction, all this is not new, but it's being implemented in a new way using carbon dioxide, right? So there are a lot of corrosion issues, for example. When we talk about amine capture technology, amine itself does corrode. When we talk about CO2 plus moisture ingress, there is carbonic acid corrosion there. So for us and the insurers, we have to understand the risks, make sure the insurance policies adequately cover the risk, but at the same time, adequately cover the insurance companies. The last thing we want to do is start placing these risks into traditional insurance programs, and we force that upon the insurers, and then we start seeing a series of losses, and nobody wants to touch that again, right? That's not what we want to do. We want to make sure that the insurance program for CCS and carbon management in any way or form is there for the very long run. And in that sense, we have to protect the insurers and also the clients at the same time.
Thank you for that. If I may turn to Maris, carbon markets, something that everybody loves to talk about, both compliance and voluntary markets. How do you see carbon markets supporting carbon capture, storage, and as well as carbon removal technologies deployment?
Oh, there we go. No, you get to keep. You're the moderator. You get one the whole time. So hi, I'm Maris with ACR, and I lead our tech-based team, and I'm the tech lead on CCS and CDR. And so this is my favorite question: and how can we support? Because we're seeing increased energy in this space and a lot more projects in the pipeline. But we're still kind of struggling to see the shovel hit the dirt. And I'm really looking at how we can sort of bridge that gap between these great ideas and actually making projects happen. And the challenge within the carbon markets is not that just the scale of these projects, which is in the, very big dollar signs and in the billions. And the carbon markets really are supportive once the CO2 starts hitting the ground. But it's that you really have to tighten that last bolt before you get any CO2 into the ground. So it's not like you're building a wind farm with 1,000 turbines, and once you have one going, you potentially have some credits that you can generate. It's really not until the whole thing is built. And so getting to FID and convincing leadership in a big company that you really need to do this, and how are we going to fund this when a lot of the incentive programs are in place, but they last 12 years, or they last less than that, or they have caps in 2030. So very few of these projects are going to pay out in that sort of time schedule. Most of them may not even be built by the time some of these programs are currently scheduled to sunset. So the carbon markets provides that level of assurance and that gap. And so when you pair it with many of the incentive programs that are working, and not just the incentive programs, but also the regulatory regimes, because I'm developing our methodology at ACR, CCS 2.0, and I'm really looking to leverage the expertise and the enforcement and the permitting requirements that are already built into the system. Certainly to make it easier from a paperwork standpoint from everybody that wants to do these projects, but also because where we can find those economies of scale and those synergies, it's really going to help support faster deployment and having just a level playing field.
Thank you. Talking about sort of storage in particular, I know that in the voluntary markets, we've got nature-based solutions, we've got engineered solutions. Clearly, one of the advantages of engineered solutions is the durability of storage, being able to measure. And do you think, therefore, that is it beneficial to have a distinction between kind of geologic storage and therefore engineered solutions or not? What's your perspective?
Like having to choose my favorite child. No, I think it's important to have, I mean, what our unit of currency in the markets is that fungible token, that ton of CO2 equivalent. And even on my team, we deal with numerous gases. And then when you compare that, and then you add the co-benefits, and you add the durability, and the measurability and the risk, all these things, and you put those in the stew, it gets pretty complicated. And it's a market, and a lot of these, it's a voluntary market. And so what someone is looking for when they're buying credits isn't necessarily going to align. But we do need to have a certain level of durability, certainly, but also the more sophisticated buyers are increasingly looking for that. And early days in the market, in the voluntary markets, when folks weren't necessarily digging in on what are all these things and sort of accepting that the credits were of high quality, those days are long gone. And those are the kind of questions that we're getting from buyers. And so what we're really trying to do, and is really hard, is because it's really trying to differentiate so that not necessarily because one's better than the other, but because one's a better fit for what someone is looking for. And actually something that I find surprising frequently is how important just geography is. And people want projects that are within a certain jurisdiction, certainly within their own value chain, so they can point to it and make it a good story that they want to tell about their credits. But really the jurisdiction has been increasingly important. So that's what we're trying to do. We're trying to match the buyers and to the projects, and doing that in a right-sized, bite-sized way, because project developers will talk to you for a very long time about the awesome parts of their project, that, we have pages and pages of data and data about the co-benefits and all the good things that went into the project. That's not accessible if someone's trying to build a portfolio of credits. So how do we, as a registry and as a market, sort of figure out what those key elements are so that we can communicate those effectively, assure those effectively, and then, make those connections.
So is it fair to say that you're saying major buyers have a portfolio approach to acquiring credits? You just mentioned geologic spread, sort of perhaps also from a durability, cost, and other kind of considerations.
Yeah, we're seeing that definitely increasingly because this is something that increasingly corporates are bragging about. They were, and now it ebbs and flows, but they want to have credits that have a good story when they're talking about them and answering why they bought a certain type of credit. And particularly if it's a credit that's within their value chains, that's something that is increasingly important. Yeah.
Thank you. Talking about durability, if I may turn to Vipul, perhaps somewhat of a controversial issue is transfer of liability after closure. That happens to be different in different places. Different stakeholders have different views on it. What's your take?
Yeah, I think from what we've seen so far, like for example, in Australia, the Western Australian government transfers that or retains their liability only 10 years after the site closure, right? So I think after site closure, a lot of different governments and regulations will maintain that liability will be with the developer until the site is stabilized, right? And I think that is the correct approach because then it gives that continued responsibility and monitoring of that CO2 even after closure. So we are going to see definitely a development and I think a mandate that your regulators will then impose on developers to make sure that environmental liability is with the developer for at least 5 to 10 years after closure. So I think that is the trajectory there, and that is the insurance solutions we're also working on, not just to have a during a storage, but post storage as well.
Thank you. So we have two our speakers just arriving. Alex Millward, he's the director of CCUS at UK's Department of Energy Security and Net Zero. And we have, of course, Julian Malcreast. He's executive vice president with Bank of America. Julian, welcome. If I may start, we've been already sort of digging a little bit into the landscape. We talked about some of the policy developments, but JP mentioned that almost all of the existing projects have been so far financed on balance sheet, and they're working on a big project, the big in Saudi Arabia of 10 million tons, and he's hoping that may be the first sort of commercially financeable project. Are you seeing also CCS carbon management projects become more financeable? And do you have any preference across applications, industries?
Look, great question. I mean, I think, look, the way I'd frame it is, look, what we're looking for from a financing standpoint is the same as on any project, right? So I think the critical bit is getting past that sort of pilot stage into a kind of commercial project. The second bit, I think, is choosing the right partners, because that's all part of mobilizing the right kind of capital behind you as well. I think that's super critical. But I do think we're getting to that tipping point in the carbon capture space, right? And I think, look, it's from a Bank of America standpoint, it's part of our sort of $1 trillion kind of sustainable finance commitment, has got as part of our internal taxonomy now carbon capture, right? So I think that's all positive. What I would say though is, this is not to duck the question, but I do think for a little while longer you're going to have to equity finance and think corporate finance balance sheets, and that's why I think the sort of clusters with big industrial players is for now still the right piece, but we're getting very close to a point where I think there'll be another phase.
Keeping our fingers crossed. Alex, before you arrived, JP was talking a little bit about the global policy landscape, and he mentioned that UK has actually kind of got probably the most financeable kind of, at least in the short to medium term kind of model. Can you tell us what you've been busy with in the past few years? And also, are there other geographies that you think are doing a great job of sort of policy when it regards to carbon management?
So I think there's many ways to achieve it and get the financing. So as a starter, and apologies for repeating, so certainly from the UK perspective, the technology is considered to work. The private sector capacity to do this is there to do it, and it really does come down to who pays what and who carries what risk, which is where we spent the most amount of our time with each. Probably over the last 4 years, as you say, developing the policy framework, there's always been the two intents. One is making sure the business models are investable and appear investable. So we spend a lot of time both with the developers and then the equity that they put in, plus also the financial institutions that might be behind them in the many different layers. So we spend a lot of time on that. We have signed on the sort of transport and storage, which has probably got more variety and complexity, signed heads of terms with one of the clusters in there, which is a step towards demonstrating investable, but I'm conscious that we've stored no CO2 yet. So, a long way to go in doing that. But and where we're in the negotiations right now with the first 10 projects, one of the reasons we put the clusters together is learning from previous lessons, which unfortunately we then stepped back, was the risk distribution between the public sector and the private sector. We couldn't get that to work, and some of that was because it was point to point which is working in some jurisdictions, which is fantastic. But the balance of risk between the public purse and the private purse, we introduced the cluster concept to add more resilience to the overall program, such that if one project came out of the program, it's less of an impact on the overall program. So it adds more complexity for sure, trying to negotiate 10 deals just in the first step, but it adds a lot more resilience, including to the public sector lens, where we're taking on the contingent liability. If one project comes out, then that's okay. And one of the reasons the discussion is happening and the public purse is what we call the cross-chain risk. So there's the codependency between the capture project and the emitter, who wants to be confident that the store is going to operate as stated, and vice versa. So when there is a mismatch between, let's say we've got 4 megatons of emissions connected into a store which is listed and rated as doing 4 megatons, and they're all due to nicely connect in a particular year. Unbelievably, some projects don't go according to schedule and to cost. It's a very unlikely situation. But what happens in that situation? Who bears that risk? So if in extremis, the transport and storage company has set up, is operational, is ready, and the emissions projects are, let's say, all late. They've incurred costs, they've incurred financing. Who bears that risk? And so with the construct that we've set up, essentially the UK taxpayer bears that timing risk, which is a key part for making it more investable into the private sector. But with the UK government, which has an officially low risk appetite, bringing us through on behalf of the taxpayer, where there's a lot of other calls on the public purse, we need to sort of manage that timing very, very carefully to mitigate that risk as much as possible.
Thanks very much, Alex. And I'd like to sort of stay a little bit on the risk point, but if I may turn to JP, I think you've got some comments, but I was wondering if you think the legal and regulatory frameworks go far enough, whether your clients are relieved, they have concerns remaining, and perhaps after you, if I can have Vipul talk a little bit about if there are any uninsurable risks with regards to CCS. I'll just
so I think the comments were really interesting, and it allows us to distinguish, the approach in the UK versus the approach in the US, right? So in the UK, the UK taxpayer at the end of the day will come in and wrap that risk. In return for that fantastic guarantee, right? Your support to the project is sized so that it is just necessary for the project to go forward, right? In the US, it's a totally different system, right? The 45Q is $85 per ton. It's the same price to everyone. It doesn't matter if it costs $10 per ton to reduce or $100 per ton to reduce, right? So like, of course, now there's a big rush to find the one project which is at $10 per ton, because that's where people are going to make a lot of money, right? But the downside of the US system is that there's no one coming at the back end wrapping up all the risks, right? So the comment that you were making about, what happens if you have a cluster and one emitter is late, or the transporter is late, or the sequestration site doesn't have its permit on time, all of those risks in the US are borne by the private sector. Right. So it will be very interesting to see how these two models evolve. My prediction before you join, and credit to the UK government, is that in the short term, I think the UK approach is likely to yield more results. But I think over the long term, because of the significant incentive that is provided by the US system, which has created a gold rush on the CCS industry, I think eventually you'll see more projects in the US coming online, when, for example, the banks finally get comfortable with, the technology, the risk, et cetera, et cetera. So we will have to see what happens. But I think what you're doing in the UK is absolutely fascinating.
The one point I would also just add into that. So I, understandably, on behalf of the taxpayer, need to get the taxpayer out of this as quickly as possible. And believe me, it make my life a lot easier if I'm not as involved in the individual choices. Because if the taxpayer is bearing a risk, it needs to assess it fairly and due diligently, et cetera, et cetera. So we're probably more involved in the intervention. Was our learning from previous mistakes. Certainly when we go and have conversations in the US, often the parties haven't even thought of the risks that we're mitigating, and so they go away and scratch their head and do a lot of thinking. But certainly they'll get deals done. So we'll be publishing very shortly, essentially, how we see the exit rate off. So certainly our shareholder representatives, our treasury, before they enter, they want to know where the exit is, because they don't want to set up, yet another sort of subsidy dependent industry. And then I think once we can get to that stage, got the momentum, confidence will come everywhere. We'll get a lot more learning where the real risks are. And then I think we can see the power of the markets make the choices of which stores go next, which capture projects are allocated to which store, and then I can have a much calmer life.
Thank you for that. And certainly we are seeing different models of deployment in the US versus the UK, but not just that. We're also seeing different modes of deployment in emerging countries. We're having, for example, state-owned enterprises in China or the Middle East come in and actually be able to deliver CCS projects at much greater pace than perhaps what we're seeing. So it's going to be a wonderful race to watch and clap from the sides. But in the meantime, Vipul, any risks that you find difficult as the insurance industry to deal with?
Yeah, I think specifically on the delay topic, we have a client who said the machinery is going to US, but they don't know where the permitting is currently at. And so they've asked us, can we ensure the delay in permitting, right? And that was something I looked into, and the answer for now is no. Right. So that is something that is uninsurable for now, because it's a moral hazard, right? When there's insurance, then there's no impetus to finish it on time to a certain degree. And they know that there's insurance coverage there. There's a moral hazard there in that degree. But what we are looking at is that if, for example, in US, there's now the DOE's $400 million grant for about 12 projects, if I'm not wrong, and then they will fast track that permitting. If we are able to understand the details of that permitting and where the current client is in that process, there might be a chance for us to get in and provide some sort of coverage. So I wouldn't say it's a hard no, but for now, we probably have to understand each and every state's regulation, country's regulation, and where they are in the permitting, and whether there's a mechanism there for us to ensure it.
And I think permitting is generally recognized as a problem in Europe, in the US. In the US, in front of the Environmental Protection Agency, I believe there are more than 160 permits for what's called Class 6 wells, etc. And in Europe, the Commission is looking to shorten the permitting timeframes, but certainly that's, we think, on the critical path to accelerating deployment in time. If I may turn to Julian and change tack a little bit, and I'm cognizant that we're about to run out of time, but ESG, is carbon management and particularly carbon capture and storage included in ESG considerations at the moment? How important it is, and how do you kind of see that evolving?
The short answer, yes, certainly as far as we manage our internal positions. So if you think of financed emissions and how we're managing our own lending portfolio, which we committed after, middle of last year, after the commitments through GFANZ post COP26. Yeah, look, if we have a client that is doing carbon capture, and that's something we'll take fully into account and give full weight to. I think in terms of a sort of pathway going forward, I also think that there is a bit more of a challenge. And one thing where you look at raising equity, there's still a little bit of the case when we're doing what I call more decarbonization type technology or looking to fundraise, we often get the feedback that it's not green enough. And I think there's a big push, which I'm part of, and another initiative to say, look, can we actually start to create some what I call olive or transition funds? Because it's a slightly ridiculous position we're in at the minute, where I was one client we were trying to raise money for recently. They got a no from several funds, yet the CIOs of several of those funds invested personally because I thought it was a good idea, but it didn't meet, it wasn't green enough for the frame of their own funds, right? So that just tells you there's a great business opportunity in this space, but maybe we haven't got all the right alignments in terms of capital. But, so.
Thank you. So, in light of the upcoming panel, which my colleague Elena is going to moderate, which is going to be about emerging markets, developing countries and emerging markets for CCS. Clearly, if we look at UK, US, EU, we kind of scale it up. We get to several 100 million tons of CO2 capture and storage capacity by 2030, but we need a gigaton. And if that's going to happen globally around the world, we need to have the emerging economies come into the picture. So I just wanted to ask, and this is a question to all of the panel, if they wish to participate from a government point of view, from a financier point of view, from a carbon markets or MDB point of view, what needs to happen in your view, or what can help accelerate deployment of carbon management technologies in the emerging countries? And are there any low-hanging fruits?
I hope so, yeah. So here at COP in particular, I'm reminded that many of these borders that we like to talk about are man-made, and they don't necessarily follow geology. So sometimes they do, but sometimes they don't. And so as we continue to watch with bated breath what happens with Article 6 and how some of that trading is going to happen, do we have time to totally get into Article 6 in the last 3 minutes? No. So no. But you know, there's going to be opportunities when we have more clarity there, and when we see permitting regimes ultimately is what we're going to need to do. Because speaking for the carbon markets, as much as I'd like to go all these places and make sure that the wells that they're drilling or the pipes that they're laying are going to be appropriate for being low risk, we can't do that, and so we need to be able to partner with those regimes. But we are open. Our methodology is global, and so we could go wherever. It can go cross borders. CO2 can start in one place and end up in another, and that's fine. But we do need to see that action taken. And there is the potential for a global sort of standard, but I haven't seen a lot of energy moving in that direction yet.
Maybe just 3 comments. I think in terms of the developing markets, I mean, one, the obvious, I think seeing the MDBs move to the same risk profile that we're seeing some IKEA Foundation or Rockefeller playing at is, I think, a critical piece. And you heard comments. I was at recent sessions with the DFI of the States talking about wanting to move up the risk curve, which is a different kind of conversation. I mean, it needs to see where it goes to, but I think that's a different kind of conversation. That's one. Second, I think it's down to partnering as well. I think you need more of the big balance sheets and bigger corporations to step up and say, look, we're going to be part of it. And the third bit, we've been pushing quite hard, trying to mobilize what I call sort of private capital. So people that previously were saying, look, they've got a philanthropic part of us, a big private business, sort of wealthy individual. Actually, look, there's a decent investment, and actually they can take a longer term view and a longer dated risk profile. So.
Alex, the UK is member of the Carbon Management Challenge, of course, one of the co-leads rather. Could you just maybe speak a little bit about that and more broadly about the kind of emerging markets point?
I think that is about raising the ambition globally to get to the gigascale that is needed for the science, and working towards doing that on 2 things. One, knowledge transfer, but emerging markets are smart people as well. They'll find their own way to figure that out. But sharing some of the technology. Importantly, accountability through transparency, and particularly from the south to the north. Do what you said you're going to do. So I welcome that transparency of the challenge onto us. And then coming onto the finance topic, the most important is the money. And I've just been with the small island development states. They'll need the money as well. And so countries like the UK, yes, we've got to get our costs decarbonised through our taxpayer, and that is difficult. But there needs to be trillions moved from north to south. These countries are not going to be able to afford it. So I think that's one. The other bit I'll sort of challenge Julian, it can't be just like every other investment. If the returns, if the salaries, if the compensation are funded by the taxpayers in the current economy, then we're not going to get to the gigascale in the time that we want. So it can't be business as usual. Everyone needs to take haircuts. Otherwise, it just won't get done quick enough.
Yeah, and I think we need to stay what is feasible and what can be done to decarbonize at scale in developing countries, right? You know, we have some groups, just to be clear, in the West, pushing our clients to decarbonize using mostly or exclusively, for example, DAC technologies at $750 per ton, which is a complete absurdity when you can have high quality projects in developing countries in the hydrogen, ammonia, CCS space at, you know, 75, $80, you know, per ton, right? So there needs to be a recognition that these projects can provide durable, you know, credible reduction. They can be paired with community programs whereby some of the revenues go back to the community, help with adaptation, resiliency, and other things. And as long as you have a strong standard like the one of ACR or the other similarly situated standards, it should work within Article 6. So I think there's a way forward. We just need to continue to work at it.
And sorry, maybe just one quick one. I actually think we're hopefully close to a point where there's going to be better returns in the risk reward basis in the south than the north, which is kind of implicit in your question. I think that's close, right?
Okay, well, can I say inshallah and therefore and bring this panel to close? Thank you so much.